Silver crashed, but because silver rose too fast. It happened before. At the end of January, when silver touched levels no one thought possible, dealers didn't celebrate. They panicked. They stopped buying. Refiners stopped answering the phone, and investors were left holding silver nobody wanted. Now the warning signs are back. And if history repeats itself, it could happen again, faster and far more painful than before. Stay until the end, because what happens next could decide whether your silver is an asset or a liability. Welcome back to Precious Metals Intelligence, the channel built for investors, strategists, and wealth-conscious individuals who prefer facts over hype and preparation over panic. Before we begin, if this is your first time here, consider joining this community of serious, forward-thinking investors by subscribing, not for numbers, but because these warnings are meant to reach the people who take their financial future seriously. To understand why investors are being warned again, one must first return to the moment everything changed. It was late May of 2025, and silver was trading quietly at $32.99 an ounce. Few people were paying close attention. It seemed like an ordinary metal moving at an ordinary pace. But what happened next would reshape the entire physical silver market and expose a weakness that most investors never knew existed. By January of 2026, silver was no longer moving quietly. It was climbing at a pace that stunned even experienced traders. On January 1st, the price stood at $71.59. Just 26 days later, it had gained more than $45 an ounce. Prices closed at $116.61. But during the trading day, silver briefly touched above $120 an ounce. For a metal that had spent years moving slowly, this was extraordinary. It felt, to many investors, like the beginning of something historic. But history, as analysts often explain, does not reward speed. It punishes it. What followed was just as dramatic as the rise itself. In a single day, silver dropped more than $30 an ounce. The fall was sudden, violent, and unforgiving. And the volatility did not stop there. For weeks afterward, silver moved up and down with no clear direction, leaving investors confused and uncertain about what to do next. To understand why this happened, one must look beyond the price chart and into the psychology of the people buying and selling silver. When an asset rises slowly over months or years, buyers and sellers tend to remain balanced. New buyers enter gradually, sellers exit gradually. The market absorbs the changes without much stress. But when an asset rises extremely fast, something very different happens. Investors who bought silver months or even years earlier suddenly find themselves sitting on massive paper profits. Someone who bought silver at $30 an ounce, or $40, or even $60, suddenly has the chance to sell near $120. That kind of opportunity is difficult to ignore. Human nature takes over. The instinct to lock in profit becomes overwhelming. This is where the real danger begins. Many investors set mental price targets long before the rally even started. Some decided they would sell if silver reached $70. Others set their limit at $80, $90, or $100. Many said they would only sell once silver crossed triple digits. These targets seemed reasonable at the time they were made, but nobody expected all of these targets to be triggered within the same few weeks. That is exactly what happened. As silver surged from $70 to $120, it did not just pass through price levels. It activated waves of sellers at every single stage. The person who wanted to sell at $70 sold. The person waiting for $80 sold. The person holding out for $90, then $100, then $110, they all sold too, one after another, in rapid succession. What should have been a gradual release of supply became a flood, all arriving at once. This is the core problem analysts point to when they say the rally happened too fast. It was not that people were wrong to want to sell. It was that too many people wanted to sell during the exact same narrow window of time. The market simply was not built to absorb that kind of pressure so quickly. Meanwhile, on the other side of the transaction, buyers could not keep pace. There were still people willing to purchase silver, but nowhere near enough to match the wave of sellers rushing in. The imbalance grew larger by the day, and as that imbalance widened, something began happening behind the scenes. Something most everyday investors never see, but something that would soon affect their ability to sell silver at all. This is where the real warning begins to take shape. It was not just about price. It was about what dealers, refiners, and wholesalers were doing quietly behind the counter as the flood of silver arrived faster than they could process it. Their reaction would end up shaping the entire market, and it would leave many investors stuck holding silver they could not sell, even when they desperately wanted to. What happened next inside those dealer shops reveals the true danger of a fast-moving market, and why the same pattern could easily repeat itself in the future. Behind every price chart, there's a quieter story that most investors never see. It is the story of what happens inside a dealer's shop when silver moves too fast for anyone to keep up. And in early 2026, that story became impossible to ignore. As silver climbed toward $120 an ounce, something unusual began happening across the country. Dealers who had spent years buying silver from customers without hesitation suddenly began turning people away. It started quietly, almost unnoticed. But within weeks, it became a pattern that stretched across the entire industry. The first casualty was 90% silver, often called junk silver. Dealers stopped purchasing it almost immediately. For many investors, this came as a shock. They had been told for years that junk silver was one of the easiest and most reliable forms of silver to buy and sell. Suddenly, that reliability disappeared. People who tried to sell their 90% silver coins were turned away, told that dealers simply could not accept anymore. But the problem did not stop there. As the flood of silver continued, dealers began refusing other forms of silver as well. Bars, rounds, and even some coins were rejected. One large dealer, a well-known operation with a major facility and a long history in the industry, stopped buying nearly all silver and precious metals. The only items they continued to accept were gold, silver jewelry, and sterling silver flatware, items where their profit margins were wide enough to absorb the risk of falling prices. To understand why this happened, one must look deeper into how the silver market actually works. Local dealers do not simply hold onto silver forever. When they buy more than they need, they typically sell the excess to refiners and wholesalers, who process the metal and prepare it for resale. This system works smoothly as long as refiners keep buying at a steady pace. But during the rush of early 2026, that system broke down. Refiners became overwhelmed. Silver was arriving faster than they could process it. Some refiners stopped buying completely. Others continued accepting silver, but they changed the way they handled pricing. Normally, when a dealer sends silver to a refiner, the price is locked in immediately. This protects the dealer from sudden price swings while the silver is in transit. But as the flood of silver overwhelmed refiners, many stopped locking in prices right away. Instead, dealers were told they would have to wait 3 to 4 weeks before a price would even be set. Only after the refiner processed the order would the final price be determined. This created a serious problem for dealers. If they accepted silver from a customer but could not lock in a price with the refiner, they were left exposed. If silver dropped in value during that waiting period, the dealer could lose money on every single transaction. Given how volatile silver had already become, this was not a small risk. It was a very real possibility. Faced with this uncertainty, many dealers made a simple decision. Rather than risk losing money on silver they could not immediately resell at a locked-in price, they chose to stop buying altogether. It was not that they didn't want the business, it was that the risk had become too high to justify it. This is the part of the story that most investors never think about. They assume that if they own silver, they will always be able to sell it. But in early 2026, thousands of investors learned otherwise. They walked into shops with silver in hand, only to be told that no one was buying. Not because silver had lost its value, but because the system moving silver from customer to dealer to refiner had become overloaded and frozen. Long before the silver market froze, there were signals. Quiet ones, easy to overlook, buried beneath the excitement of rising prices. Analysts who study market behavior say these signals are almost always present before a sharp correction. The challenge is that very few investors notice them in real time because excitement has a way of silencing caution. The first signal was speed. Silver did not rise gradually over years, the way it typically does during a healthy, sustainable bull market. It rose in weeks. A move from the low 30s to intraday highs near $120 is not a normal progression. It is a compression of years of expected gains into a matter of months. When markets move that quickly, something is usually being skipped. And what gets skipped is balance. Balance between buyers and sellers. Balance between supply and demand. Balance between excitement and discipline. The second signal was public attention. As silver approached historic highs, it began appearing everywhere. News coverage intensified. Conversations about silver spread far beyond people who typically follow precious metals. Investors who had not thought about silver in years suddenly found themselves paying close attention again. This kind of widespread public interest often feels exciting, even validating. But analysts who study market cycles view it very differently. Historically, when an asset becomes a mainstream topic of conversation at the exact moment it is hitting record highs, it often signals that the rally is nearing its most fragile stage, not its strongest one. The third signal, and perhaps the most important one, was investor psychology. Many people who owned silver had, at some point, set a mental price target for selling. Some had decided years earlier that they would sell if silver ever reached $70. Others waited for $80 or $90 or the symbolic milestone of $100. These targets were not irrational. They were based on patience and long-term thinking. The problem was not the targets themselves. The problem was timing. Because silver moved so quickly, nearly all of these targets were triggered within the same narrow window. Investors who had been waiting patiently for years suddenly found their price target hit within days of each other. What should have been a slow, staggered release of silver into the market became a single, overwhelming wave. Everyone tried to sell during the same short period for the same basic reason. The price had finally reached the number they had been waiting for. This is where the difference between short-term thinking and long-term thinking becomes critical. Investors who were stacking silver purely for long-term wealth preservation were far less affected by the chaos. Their intentions had never depended on selling at a specific price. But investors who were stacking with the specific goal of selling for a large profit found themselves caught in the same crowded exit, competing with thousands of others trying to do the exact same thing at the exact same time. Analysts point to this pattern as one of the clearest lessons from the entire event. It was not simply that silver rose too high, it was that too many people were relying on the same narrow set of price triggers without realizing how many others were waiting for those same numbers. When those triggers activated together, the market could not absorb the pressure. Looking back, the warning signs were not hidden. They were visible in the speed of the price movement, in the sudden wave of public attention, and in the shared psychology of investors who had unknowingly synchronized their decisions without ever speaking to one another. Understanding these signals matters not because they predict the exact timing of future events, but because they reveal how markets can shift very quickly beneath the surface, long before dealers ever start turning customers away. The real question now is whether these same conditions could form again, and if they do, what would actually need to happen for history to repeat itself in an even more disruptive way. Understanding what happened in early 2026 is only useful if it helps investors recognize the same pattern before it unfolds a second time. Analysts who study market cycles agree on one central point. This was not a random accident. It was the result of specific, identifiable conditions. And those same conditions could form again under the right circumstances. The first condition is speed. A slow, steady rise in silver prices rarely causes dealers to stop buying. When prices climb gradually over several years, the market has time to adjust. New buyers enter naturally. Sellers exit in small, manageable waves. Refiners and wholesalers can keep pace with the flow of metal moving through the system. But when prices rise sharply within weeks or months, that balance disappears. The faster the climb, the less time the market has to absorb it. This is why analysts pay closer attention to the rate of a price increase, not just the size of it. The second condition is public attention arriving at the wrong moment. When an asset becomes a mainstream topic of conversation exactly as it reaches record highs, it tends to draw in investors who are reacting emotionally rather than strategically. This surge of last-minute participation can temporarily push prices even higher, creating the illusion of unstoppable momentum. But it also sets the stage for an equally sudden reversal, since many of these late participants are the first to panic when volatility appears. The third condition is synchronized investor behavior. As explained earlier, thousands of investors had set similar price targets without knowing that so many others had done the same. When those targets are spread out naturally over a long period, the market barely notices. But when a rally compresses years of expected gains into a few weeks, those targets activate all at once. This creates the kind of concentrated selling pressure that overwhelms dealers, refiners, and wholesalers simultaneously. For this pattern to repeat, analysts suggest a similar combination would likely need to occur again: a rapid price acceleration driven by a real economic catalyst, followed by intense media coverage that pulls in a wave of new, emotionally driven buyers, followed by a large number of long-term holders deciding to sell at nearly the same time. Several broader economic conditions could realistically set this chain of events into motion. A sudden shift in monetary policy, such as unexpected interest rate changes, could send investors rushing toward precious metals as a safe haven. A rapid decline in currency value could create similar urgency. Geopolitical instability, banking concerns, or sudden inflation spikes have historically triggered fast, emotional moves into silver and gold. None of these outcomes are guaranteed, but each of them has happened before, and each has the potential to compress years of gradual price movement into a much shorter, more volatile window. It is important to note that analysts are not predicting a certain event. They are outlining a pattern of vulnerability. The conditions required for a repeat scenario are not rare or extreme. They are, in fact, relatively simple. A fast price movement, widespread public attention, and a large number of investors reaching their personal selling point at the same time. Given how interconnected global markets have become and how quickly financial news now spreads, some analysts argue the next disruption, if it happens, could unfold even faster than the one in January 2026.